Hi everyone, this is a technical analysis on USDCAD. Let's start with some fundamental background first. In the US, the Fed left interest rates unchanged as expected at the last meeting. The macroeconomic projections were revised higher, and the dot plot showed that the FOMC still expects another rate hike by the end of the year, with less rate cuts projected in 2024. Fetcher Powell reaffirmed their data dependency, but added that they will proceed carefully. The US core PCE last week came in line with expectations, so the market's pricing barely changed. The labor market remains pretty resilient, but we are starting to see some weakness as continuing claims missed expectations once again last week, pointing to an upward trend. The US retail sales recently beat expectations by a big margin, with positive revisions to the prior figures, suggesting that consumer spending remains resilient. The recent US PMIs show that the economy now looks more balanced. Fetcher Powell and other FOMC members continue to highlight the rise in long term yields as doing the job for the Fed, and therefore they are expected to keep rates steady this week. The market doesn't expect the Fed to hike anymore. In Canada, the BOC left interest rates unchanged at 5% as expected, but remains prepared to raise rates further if needed. BOC Governor Macklem delivered a less hawkish speech in the press conference compared to his previous remarks. The Canadian CPI last week missed across the board, and the underlying inflation measures eased, which was a welcome development for the BOC. On the labor market side, the last report beat expectations and showed another uptick in wage growth, which is something that Governor Macklem said the BOC is watching carefully. The market doesn't expect the BOC to hike anymore. On the daily chart, we can see that the USD-CAD pair reached the key 138.62 resistance level and got rejected as the seller stepped in with a defined risk above it to target the bottom trend line. We can notice that we had a divergence with the MACD right at the resistance, which is generally a sign of weakening momentum, often followed by pullbacks or reversals. In this case, we should get at least a pullback into the bottom trend line here around the 137.50 level, where we'll also find the red 21 moving average for confluence. On the 4-hour chart, we can see that from a risk management perspective, the buyers would be better off waiting for the price to fall back into the support zone around the 137.50 level, where we can find the confluence of the trend line, the 38.2% Fibonacci retracement level, and the previous swing level. The sellers, on the other hand, will want to see the price breaking lower to increase the bearish bets into the next major trend line around the 136 handle. On the 1-hour chart, we can see that we had another divergence with the MACD, signaling a pullback right at the resistance. If the price breaks through the recent low here around the 138.12, we can expect more sellers piling in and targeting the 137.50 support zone. This week, we will get lots of tier 1 data points with the US labor market and the FOMC decision in focus. Today, we have the US Employment Cost Index and the Consumer Confidence Report. Tomorrow, it will be the time for the US ADP, the ASM Manufacturing PMI, the job openings data, and the FOMC rate decision. On Thursday, we will have the US jobless claims data, while on Friday, we conclude the week with the US NFP report, the Canadian labor market data, and the ASM services PMI.